taking proactive action, looking at that kind of data as well. Let's find out what Mayuresh Joshi makes of it. He's back with us here on this edition of India Tonight, the head of equity at William O'Neill India. Mayuresh, always good to get your perspective. If you were to consider, Mayuresh, the seasonal factors that hit us in the month of January, at least what we've seen over the last 10 years, what have you observed as trends? And which of these trends are the markets, in your opinion, most likely to buck this time around, looking at the current ebb and flow in the markets?
Evening, Vikram. Always a pleasure to be on your show. Two perspectives here. One, I think all the preceding Januaries that we've probably seen, a few years back, it was marred with the horrific COVID and the aftermath, but because of liquidity, markets were in fine fettle. However, I think January is one of the months where the new calendar year or the financial year begins for most developed countries. And therefore, I think decision-making in terms of discretionary spends, as an example, when it comes to the IT sector, bringing up the estimates for the current financial year, all start happening in January. And therefore, there are a lot of global events that probably take shape as we head into the new calendar year. Having said that, and in the Indian context itself, obviously two important trigger points will come in January, apart from all that was mentioned by your analyst as well. One, I think the earnings season will begin in full flow. And therefore, the street will be excited to see how the earnings are playing out, specifically sequentially, as well as on a year-on-year basis, and which sectors are probably showing the signs of growth and momentum in earnings that have carried the equity markets to newer highs as we speak. So that is as far as the micros are concerned. At the same time, I think the macro event, which is expected on the 1st of Feb, though it might be an interim budget, any key announcements thereof will be keenly watched and observed by the markets for the full budget after the general elections are over. And obviously, I think the macros have held up pretty well. Corporate debt to GDP is at an all-time low. We are talking about tax collections at an all-time high. And the current account numbers which are coming in, along with the fiscal numbers, are very manageable, which probably means that the economy has been managed very, very well. And therefore, with the rate cut scenario that happens at the latter part of this calendar year, that is FY24, we're obviously going to see more flows come into India because of the sheer stability that macros, a stable government, as well as corporate earnings from the micro perspective has to offer. Therefore, January might be, again, a month where I think both these events will play out. But structurally, I think the story for India still continues on a very positive note.
Indeed, and that's exactly what you've been pointing out. The structural story is intact. So whether it's the month of January or any other month, that is a longer-term theme that we are going to stick to. But specifically, when you talk about sectors and stocks that are affected the most by seasonality, especially in the month of January, our research shows that metals, realty, pharma, they seem to be some of the most susceptible to a fall in January. How does it look this time, at least some of these stocks and sectors that seem to end in the red when it comes to this particular month?
That can be a possibility. And again, I think most sectors, Vikram, have done exceedingly well. I think a couple of sectors which were seemingly laggards or under-owned, at least from an institutional perspective, largely pharma and some pockets of IT, which is large cap IT, because mid cap IT has done exceedingly well, have also started performing reasonably well. Having said that, if there is some intermittent correction which happens in sectors like real estate, as an example, I think that will be welcomed by the market with both hands. We're typically into a cycle of 6 to 7 years, and we're at the midpoint of the real estate cycle. You're still seeing launches being matched up left, right, and center. And the kind of numbers are mind-boggling in terms of the pre-sales on the date of launch itself. So I think the kind of demand-supply dynamics that is probably affecting the sector in a very positive manner. The expectations of us being in a mid-cycle as far as the real estate is concerned, the unsold inventory coming off every passing quarter. And again, the expectations of rate cuts, which probably means that the ownership in terms of owning a house and the expectations in terms of the mortgage rates actually coming down. Fence sitters will also jump in the next calendar year as this scenario plays out. So I think markets will welcome any sort of correction that probably happens in sectors like real estate, as an example, which probably looks to be in the mid-cycle of a good momentum and a bull run of sorts for all positive macro factors surrounding it. will be welcome. At the same time, I think pharmaceutical as a sector will also emerge as a very defensive bet because earnings are expected to become reasonably stronger as we head into the next 2 years. Obviously, any positive news in terms of FDA concerns coming out is going to be a huge positive. And therefore, I think both these sectors will be watched out for the market. And as I said, I think any correction on any of the sectors will be watched out by domestic investors to probably get in, or even the retail part who probably missed a better part of this rally that had gone on for the last.
But that kind of correction, are we likely to see traction build up again in the broader markets? Because that has run up so substantially this year. 44.4% gain on the mid-cap index and nearly 54% gain in the small-cap index, Mayuresh. That's where also we saw the sharp correction happen in a month that was doing so well. And there was this strong bullish trend. And you said in a bull market, these kind of corrections are to be expected. But when it comes specifically to the broader markets, what do you think is likely to happen in January?
No, so you're absolutely right. I think the broader markets are in a different zone altogether. And the kind of run-up that we've probably seen for most stocks within these spaces, whether it's the mid-cap or the small-cap, the kind of rally has been humongous. Having said that, the valuations probably look stretched as we speak at this juncture. And at MarketSmith India, we also track the stages or they're in late stage basis, which means that the expectations that the markets have from the broader market in terms of earnings growth continuing at a certain pace over the next few quarters. I think any one quarter of disappointment in terms of earnings growth might pull down these stocks quite significantly. A lot of stocks, Vikram, have moved 2x, 3x times. I think people are sitting on a lot of money. There is that reluctance to sell as well. And therefore, a shakeout, if it happens within the broader market, for any of these reasons, the primary reason being an earnings miss, as we see it, can be a welcome sign. But you need to be a little bit more careful within the broader markets. From the fairly valued zone, I think a lot of stocks have probably entered overvalued zone at this juncture in late stage basis. And therefore, just having that feeling of missed out of not probably entering the larger space maybe a few months back might come to the minds of investors. But you need to be a little bit more patient and wait for those corrective actions to take place and invest in those qualitative pockets within this universe as well. So as I've always mentioned, Vikram, I think the market is a very efficient platform which transfers well from the impatient to the patient. So be a little bit more patient to probably enter these spaces.
Patience is what one requires, but if we see the markets at 21,440 odd levels right now, by the end of January, since that's the particular month we are focused on, where do you see it at the end of January 2024? Do you want to hazard this one?
So $1 million question. I think everybody wants 22K on the index itself. But again, I think here's where the valuation matrix comes in place, right? With the expectations of a soft landing in the US, macro data points improving in Europe as well. The export-oriented sectors where the expectations at the beginning of this calendar year was that they might take a beating. The earnings might hold up for them in the next calendar year, and you will see a sharp revival happening as restocking takes place, the PLI schemes, the China Plus One, so on and so forth, and the services part still expected to do well. And therefore, if the Nifty EPS as a consensus is expected to be around 1100 odd, you're still looking at the markets at 19.5 times forward, which is again the median range in terms of the markets being fairly valued as we speak. And therefore, I think from an earnings perspective, if the numbers come as per expectations of the markets, there is still scope for the index to move higher over the next few months. And obviously, I think the comfort between large and small caps stays with the larger names at this juncture. And again, as I said, a welcome move if there is some element of correction in some strong pockets within the broader universe. But please don't chase stocks unwarranted in these markets. Be a little bit more patient. The time will come. And at that time, please do invest and don't back out.
So the markets, as far as January are concerned, Mayuresh, is pretty certain we are likely to move up. So in a sense, we are saying that we will buck that January trend, at least what we've seen over the last 10 years. Mayuresh, thank you indeed for joining us. As always, it's a pleasure having you on India Tonight.
Thank you, Vikram.